Hello everyone, and welcome to episode of Dissect the Trade, YouTube channel's Option Traders United. It's been about a year since I've done a video, so I hope to have more out a lot more frequently. Guess I should give a little update as to what I've been doing in the process. When I had started this channel, I was working full-time, so my time was more or less all over the place. My job had me traveling, so I really wasn't able to be consistent. Since then, I have became self-employed, and majority of that has been not even needing to do that because of trading. And since we have a pandemic currently going on, I figure might as well make use of that time in teaching others some options trading strategies, better explaining them. You can then learn these skills and apply it in your trading. So to start out, this video is going to be about put credit spreads. So what is a put credit spread? A put credit spread is a combination of two different strike options, usually called legs, done on the same expiration. One side is bought while the other leg is sold, and profit is made by the difference between the two options, and you receive that credit up front, but it becomes fully realized when both legs expire worthless. So how do these kind of positions make money? A put credit spread will make money. It's effective as long as the underlying security either doesn't move, meaning it trades in a very tight range throughout the period of time up until expiration, or goes up. And what I mean by a tight range, specifically what I mean right here is we're going to be talking about 0 day till expiration trades. So these are going to be over a period of 6.5 hours. In periods of low volatility, it is a lot more common that you'll see tight ranged, you're talking anywhere between 5 and 10 points throughout the day. Those options pretty much just lose value over time and become worthless. That's what consolidation is considered, and those are pretty great days for those that put on credit spreads. A put credit spread will fail if the price of the underlying decreases as time goes on and ends up in the money. Meaning, whatever strike that you had sold options from, and there will be an example of this on the next slide, if the price of the underlying drops below that strike, you will experience max loss if it is still below the strike price by the end of day on that option's expiration. So why would you do a credit spread? A put credit spread, there's also it's called a call credit spread, which is basically the same thing, but I'll do a separate video on that and keeping it very specific. A put credit spread is a good way to generate income. That could be weekly, monthly, quarterly, however your style is. It's a good way to generate some money. They are defined risk reward strategies. You know how much you're going to be getting, and you know how much you're putting up to risk at the time you put on the trade. You aren't going to make, or you aren't going to lose any more than what the trade is currently set up as. Although there's a little caveat here, and I should have put that in. You can lose more than what you put in, and this is if that short strike, or I guess even the long strike, for example. So the long strike, it would be your obligation or your right to buy. But if that short strike goes in the money and you have not exited the trade, there is a very, very high probability that you will be what is called assigned. And basically what that means is someone is exercising their right for that contract, the opposite side, the buyer. So securities like Apple, any of your equities, you run a risk of assignment. And what that means is if that buyer decides to exercise that options contract, you'll be obligated to deliver. You'll be obligated, meaning you have to give them their 100 shares or however many contracts you have that you're selling. And say for a stock like Apple, for example, currently it is trading for, I'm pulling up my Thinkorswim on my phone, it's $310.13. So 310. So say you sold a 300 strike and it dropped $295. Well, you are obligated to give the equivalent of, or so 100 shares times however many contracts you had. One contract is 100 shares. So that would mean that if you had a 300 strike that you were selling and you were assigned, that means you are obligated $30,000. So don't ever let a short side or the side that you are selling contract go in the money, and don't be holding it before the end of the day, because your risk of assignment will go up greatly. This is also a reason why SPX is a good instrument to trade, because there isn't early assignment. It's called cash settled. There's no product. It's just cash. There are some caveats, other things to point out about SPX. I'll maybe do another video on that, and it involves it's called the set price, and that only typically involves the monthly expiration on SPX, which is the third Friday of the month. I believe it expires in the AM, which typically one should not be doing that if they are fairly new to this, because there's overnight movement, and you really have no control at that point, because the market opens at 9:30 Eastern time, and the price will adjust based on the futures movement throughout the night, and very easily your position can go from a positive to a negative or vice versa. So it's very highly not recommended unless you're willing to pretty much blow that amount of money. So next slide. What are the mechanics of a put credit spread? There are two legs. There's either your short side, the leg that you are selling, and then there's the long side, the leg that you are buying. The strike is the price of the underlying The strike is the price of the underlying. In this case, your thinking will not be reached by expiration. And the expiration is the date that the contract expires. As I had mentioned, we're talking about 0 days to expiration, otherwise known as 0 DTE. You may have seen this in any stock groups on Facebook or any publication that talks about options. DTE stands for days to expiration. So this is meaning that you have the potential to basically make however risk adverse you want to be, but you'll be able to make this within a 6.5 hour time frame. So what are the mechanics of a put credit spread? So how the spread works is you have a short side and have there's a bid price. In this example, it is $1.55. And this is how they will always look on any platform. They'll look like $1.55. But you always have to remember that with options, everything is multiplied by 100. So this is, in this example, that is actually $155 per contract. The long side, which is taken at the ask, in this example, is $1.30 or $130. Now the difference between the two strikes is your profit per contract. So in this example, that would be 25 cents or $25. Like I said, every contract you multiply the value shown by 100, as one contract controls 100 shares. Your max risk. This is your difference between the two strikes that are chosen. So in this example, I'll be using the SPX at the strike of 28.40 and 28.45. The difference between these two is 5. Since we are multiplying this by 100, that means the max risk is $500 per contract that I decide to sell. The stop loss. This is the amount that you are going to be willing to accept as a loss, which will be much less than the max loss should it expire in the money. General rule here is to give yourself enough room for the position to work, but not too big that you'll experience a significant loss. About 3 to 4 times the credit received is a good average to give yourself some time. So an example, if you're collecting $2.50, yep, that's a typo. I gotta fix that. So if you're collecting $250, basically that would be 10 contracts at 25 cents. That's what that was here. Then your stop should be between $750 to $1,000, or 75 cents to $1. This also means that at 10 contracts in this example that I have written here, your max risk will be $5,000 minus the credit received. So $4,750. So now I'm going to put this into I'm going to pull up the platform and show this trade how it can be done through TD Ameritrade's Thinkorswim platform using on demand. So here's the platform. I have it in the on demand environment, and I have it set for May 6th, 2020, which was this past Wednesday, and time is starting at 9:32. The reason why I have it starting at 9:32 is the on-demand environment doesn't like to fill options immediately within the first couple minutes. So what we're going to do is we're going to look for the 0 days to expiration contract, which is right here. We'll wait for this data to load. If it will load, why hasn't it loaded? Okay, there we go. Okay, so here's all the option chains. This is the put side. These are the strikes. In that example that I was talking about, the 28.45 and the 28.40, so $1.55 and then $1.30, and the difference between those two is 25. There is a bit of a. This is also consider the spread. So it's $1.15, $1.30, $1.55 to $1.75. So while I would like to set this up for, say, $25 per contract, that may not happen. And it especially more than likely won't happen in this on-demand environment because it's a little weird like that. It's not exactly like the mechanics behind it is real, but it doesn't feel like it would during live trading. So when you set a limit order, it will fill at that price or very close to that price, depending if there's a huge, like, fast movement. It'll do its best to fill at whatever price you set. In that case, that's where I'm using the $25 dollar credit for. I already have this set up. This red line will be that this price action, so every single one of these is called the candlestick. It's basically the current price, how much it has moved within that certain time period. I have these, so this is set to every 30 minutes. So every single one of these is 30 minutes. This example right here, this was Tuesday. This is how the underlying SPX moved throughout the day. So what I'm going to do is I'm going to set up this position. So we're going to sell the 28.45, and then we are going to buy the 28.40. And I'm going to do 10 contracts. I'm going to change this order to a limit. See, it's probably going to fill at 42 or around that, but you would use a limit order. Let's set this. I'm going to set this at 25. Confirm and send. And now the order is set. Start the clock. And you're gonna see how this will start to move within a couple minutes. Now, because I did 10 contracts, that means my max risk is 5,000 minus the profit that I can potentially receive. So in this case, because it's in the on-demand environment, that would be you'd take the 1.52 and subtracts the 1.17. So my total profit on this trade is, oh, there it is, trade price. So 165 minus 123, 42. So it ended up filling at the market value that you saw, or when I switched it to limit, of 42. So 42 times 10 contracts is $420. So my max loss, if I do not set a stop loss on this position, is 5,000 minus 420, $4,580. If I let this position expire in the money, which means below this line. In this example, because my short side is the 28.45. This is the side that matters. If the short side, the one that you are selling, ends up going in the money, even if it's 1 cent in the money. So if this ends at 28.44.99, I will experience max loss, which that's what our stop loss is for. That is why we don't ever want it to get there. So what I'm going to do now is I'm going to create a order for a stop loss. So I create closing order. I highlighted them both. That way it knows that I want to close this out as a spread. And I'm going to change this to a stop. So because it did it at 42, which is a really awkward price, like if it was at 25 and I'm going 3 out, then that's pretty simple. That's, 25, 50, 75. 4 times is $1. So at 42, I'm going to do it at 3 times. So that would be 126. Meaning the most I'm willing to accept as a loss on this position is $1,260. Hopefully it doesn't fill it in this on-demand environment. Okay, it didn't. Now, as you can see right now, this position has only been on for not even 5 minutes, and you're looking at $120 profit. Of course, this is optimal. So it might actually be maybe 60 to 80. But now what I'm going to do is I'm going to fast forward to the last 5 minutes of the trading day. See, so that would be 15:55. Now, before I do this, I want you to take note at the pricing of these contracts. So $1.07. Oh, it's not gonna let me. There we go. So the 28.40 strike, $1.02, and the 28.45, $1.32. Okay, let's pay attention to that. All right, So it's loaded and it's on the last 5 minutes of the trading day. Now look at the mark. There we go. So the 2840 is now worth $2.50, and that short side is worth $17.50. So as time goes on, as this gets closer to expiration, see all these other contracts, they're now almost practically worthless. So as long as this price action doesn't fall below here, you'll have realized full profit. So now what I'm going to do is I'm going to speed this up to the end of the trading day. This is the closing bell. It's pre-buffering. Alright, so from this point on, there's no more trading that can be done on this option. It didn't fall below the line. It got pretty close though. $3. $3.42. This doesn't technically still show it as 0. So let me see what happens if I fast forward a day. Like it would take overnight to clear the position. Yeah, see, it still didn't change. But these would be considered 0, and so it's not showing the true value, but you would have made $420. So that is pretty much how a put credit spread is set up and how it is used to generate money. Then you could do the same thing again, say Friday. This was last Friday. I'll change the time here. It's 9:32. I'll pause it real quick. Okay. Now, how to determine when to enter one of these positions. So what I'll do is I set the chart to a daily chart. Now, granted, this isn't 100%, especially given the current market environment. We're currently dealing with the pandemic. The market is seeing significant volatility. Any given time, things could, flip on its head. But for the most part, aside from this technique tends to work out over the long term. As you can see, what I mean by volatility, like even though this is still considered an uptrend, you see we had a big day. Overnight looks like it shot up high and then it fell. So it was probably a down day, but from the overall look of things, it's in an uptrend. Good day, see, good day, bad day. Then if we go back before all this stuff happened, they're more tighter together. The volatility wasn't nearly as bad as it is now. So you always have to consider that. You always have to consider the current market environment before you put on a position, and think about that when you're determining how much you are willing to risk. There's no reason to risk more than you are willing to lose. And you don't want to add yourself any unnecessary risk that you would feel uncomfortable with, if that makes any sense. But so what I will do is I look at the trend and I see that we're in an uptrend. So I go, okay, let's see what kind of position I can get on. So I'm going to try to go as far as in the money as I can that would still generate a decent profit. And typically how I'll do this is I always go by the bid and then the ask. So in this case, the ask on an option that is further away from in the money is more than the bid on the strike that is closer to in the money. So this would actually be considered a debit spread, which this is what you are paying out first. And I that's a video for another time. So I want to look for, like here, for example, 145, the 2870, and then the 2865 for 120. So the difference there is 25. So set the position, 10 contracts, set this for a limit, and it's going to fill it at 45 again, so that's going to be $450 through this platform, but realistically that would be $250. Confirm and send, and 152 minus 108. Yeah, filled it for 44. So in this example, through this on demand, that means my max profit by the end of the day will be $440. That means my max risk that I'm looking on this position, if I do not set a stop, is 5,000 minus 440, $4,560. Again, my stop would then be 44 times 3, $1.32 or 132 times 10, which means I am allowing a max risk of $1,320. So I will go ahead and set that up real quick. $1.32. Confirm and send. And let it do its thing. So I'll fast forward to the end of the day to save some time here. Okay, we're at the end of the day. Now, my position here is saying I did not want it to go below 28.70. So 28.70 is right here. $28.70. And as you can see, it went up. It wasn't even close to touching it. So that was, don't want to say easy, because it's never really considered easy. But I didn't have to manage this position. And even with my stop being set right after I put on the trade, there really isn't much managing going on. I mean, if I did get stopped out, I could potentially put on another position to make back some of that loss that would have been taken. But today was a fairly straightforward kind of day that happened. That's basically how you make money on a put credit spread. I apologize if this video, if I seem like I was jumping around a bit. I'll get better with that in time. Please give me your thoughts, opinions on this video, and give it a like, subscribe, thumbs up, hit that notification bell if you'd like to see more videos in the future. And until then, happy trading.